You just closed a losing trade, your chest is tight, your jaw is clenched, the red number is sitting there on your screen and part of you is saying just leave it alone. And another part, the louder part, is already opening the same position, opposite direction, double the size. That's not discipline failing. That's your brain running a script it learned years ago. Today we're breaking down why revenge trading happens, what your brain is actually doing in that window, that 30-second gap between a loss and a new trade, and 3 concrete rules that stop it before it starts. This is Trading Psychology. Let's go. Name's your host. I've spent years watching traders destroy accounts not because they don't know the strategy, but because they never learned the one skill that actually determines whether they stay in the game, knowing when to walk away. Today we cover 1. The mistake that turns a normal loss into a spiral. 2. Why taking a break doesn't work. 3. The 3-rule system that stops revenge trades before they happen. The single biggest lie traders tell themselves after a loss is, "I just need to make it back." That sentence is more dangerous than any indicator you'll ever trade, because it reframes a trading loss, which is just a cost of doing business, into a personal debt you owe yourself. When your brain hears debt, it doesn't stay in analytical mode, it switches into survival mode. And survival mode doesn't care about risk management, it doesn't care about your edge. It cares about one thing: get back to zero right now. This is called break-even seeking, and it's the gateway drug to every blown account I've ever seen. A normal loss is data. A revenge trade is an emotional bet dressed up as strategy. Most people think revenge trading is about anger. It's not, it's about shame. You don't want to be wrong, so you re-enter to prove the market made a mistake, not you. That distinction matters because the fix for shame is completely different from the fix for anger. Anger you can breathe through, shame you have to reframe. Next, why take a break fails. Everyone's heard the advice: after a big loss, walk away for an hour. Every trading course says it, every mentor says it, and almost nobody does it. Why? Because most traders don't actually physically walk away, they sit there, staring at the chart, refreshing the same ticker, checking their P&L every 3 seconds. Their body is at the desk, but their brain is replaying the loss on loop, and every replay strengthens the neural pathway that says, fix this now. Walking away physically isn't enough if you're still mentally replaying the loss. The mind doesn't care that your body left the room. The fix isn't a timeout. The fix is a pre-committed trigger, a rule you set when you're not in the heat of the moment that forces action before emotion takes over. Think of it like a dead man's switch. You set it before the session. If the trigger fires, you must stop. No negotiation. Now the 3-rule system. Rule 1, the 2-trade rule. If you lose 2 trades in a single session, you are done trading for the day. Not for the hour, for the day. This is non-negotiable. 2 losses in a row is signal, not noise. The market is telling you your edge is gone, your read is wrong, or the conditions don't match your strategy. Ignoring it once is a mistake. Ignoring it twice is a pattern. When I say done for the day, I don't mean switch to a smaller account or trade on demo. I mean close the platform. Walk away. Come back tomorrow with a clear head. Rule 2, no position size increase after a loss. You cannot add to a losing position to average down within the same session, period. This rule trips up even experienced traders because averaging down feels smart. You bought at 42, it's at 38, so you buy more at 38 to lower your average. You're buying the dip. But what you're actually doing is letting a loss grow because your ego won't let you be wrong. The market doesn't know you average down, your account balance does. Rule 3, the 5-minute voice memo. Before you enter any trade after a loss, you must record a 60-second voice memo stating 3 things only: your entry reason, your stop distance, your position size. If you can't say it calmly without hedging, without adding caveats, without saying, well, it might bounce because, you don't take the trade. This single rule cuts revenge trading by about 70% in the traders I've watched implement it, because it forces your analytical brain back online before your emotional brain can click the button. Let me give you a real example. I worked with a trader named Marcus last quarter. Thursday morning, he took a bad scalp on Nvidia. Down 3.2% on the position. 40 minutes later, same session, same account, he doubled down on a Tesla call option. Down another 4.1% by close. His accountability note the next day: I wasn't trading, I was proving the first trade was wrong. That is the exact loop we're breaking today. Marcus implemented the 2-trade rule. 3 weeks later, he had his first green week in 2 months. Not because his win rate changed, because he stopped the one behavior that was draining his account faster than any strategy flaw. Here's another one. Traders call her Leela. Leela was a discretionary day trader, tech stocks, Nasdaq 15-minute charts. She had a rule: never hold a loser overnight. Good rule. But after 3 losing trades one afternoon, she broke it. She held a Netflix position into the close because she knew it would bounce. It gapped down 6% at open the next morning. Why did she break her own rule? Because one loss hurt. 2 losses hurt more. 3 was unbearable, so she reached for the one thing that could erase all 3 in a single trade if it worked. That's the revenge trade fantasy. I don't need 3 wins. I need 1, and 1 high-risk trade is almost never the answer. The 2-trade rule would have caught Leela at trade 3. She wouldn't have been allowed to hold overnight, but more importantly, she wouldn't have feeling like she needed to prove something to herself. That's what pre-committed triggers do. They remove the negotiation with your future emotional self. The lesson isn't that losses don't hurt. They do. The lesson is that hurting doesn't give you permission to stop thinking. 3 rules: 2-trade daily limit, no size increase after a loss, 60-second voice memo before every re-entry after a loss. Write those down, put them on a sticky note on your monitor. Say them out loud before you open your platform. If you found this useful, the algorithm rewards one thing: comments. Drop STOPPED if you've implemented these rules. I read every response. And if you're serious about fixing your process, the next video shows you how to build a pre-session checklist that catches mistakes before they become losses. I'll see you in the next one.